greed or policy errors, maybe just bad math.
Uh-huh.
But today, we're finding physics.
It is a wild ride today. We're looking at a stack of documents that basically argue the entire global economy is running on, well, an outdated engine.
An engine that violates the fundamental laws of nature.
Exactly.
Yeah.
And we're not talking laws of nature in a metaphorical sense.
No, this is thermodynamics. This is entropy.
It's heavy stuff, but it explains so much about the chaos we see in the markets.
So let's lay out the stack we're working with. First, we have the technical white papers for the QGOS.
The quantum governance operating system.
Then we have a really heavy critique of modern Islamic banking from a scholar named Mufti Taqi Usmani.
Right. And finally, this strategic analysis paper called The Entropy Trap.
And the mission for this deep dive is to connect those dots. Because on the surface, you've got a religious scholar on one side and physicists on the other.
But they're actually describing the exact same problem.
The premise here is really provocative. The idea is that the next revolution in banking won't happen because banks suddenly decide to be nice. It's not about corporate social responsibility.
No, not at all. The argument here is strictly about survival. It's the idea that our current model, what the papers call rational thinking economics, is mathematically doomed to create chaos.
And the only way out is to introduce a new kind of physics.
A new operating system for the economy.
So if you're listening and thinking, I don't care about banking regulations, stick with us. Because this isn't about regulation. It's about why the world feels so chaotic and the, well, almost sci-fi solution that might fix it.
Let's dive in.
Okay, I want to start with this concept of the old physics. The sources use this analogy of Einstein's equation E equals mc squared to describe modern banking.
Right.
Now, I know that from high school physics, but how on earth does that apply to my checking account?
It's a brilliant metaphor they use. In the rational thinking model, which is just, standard capitalism, they treat capital as the mass. That's your M.
Okay, capital is mass.
And the velocity of money, how fast that capital changes hands, that's the speed. That's your C.
So the energy, the E, or the value created, is just a result of taking a massive pile of money and moving it as fast as you possibly can.
Precisely. The goal of the whole system is to maximize and get more money and
Yeah.
maximize C, move it faster. That's the game.
High-frequency trading, leveraged buyouts.
It's all about speed and mass.
That sounds, it sounds efficient. Move money fast, make a profit. What's the problem?
The problem, according to the QGOS white paper, is that the equation is missing a variable. It assumes you can have infinite growth in a system that is very much finite.
Right.
And in physics, when you accelerate mass without any kind of control, what do you get?
You get heat, you get friction.
You get entropy. The sources call it high network entropy. And by optimizing only for efficiency, what the Islamic finance papers call use or ease, you strip out all the safeguards.
You strip out the truth, the verification, the relationships. You just want the transaction to happen now.
Right.
So something like the 2008 financial crisis. In this framework, that wasn't just a few greedy bankers making bad decisions.
No. In this framework, 2008 was a physics inevitability. It wasn't a bug in the system. It was a feature of the math. The system got so efficient at moving capital at that C squared that it removed the friction of actually checking if people could, pay back their loans. The old physics created what they call a ferrotopology.
Ferrotopology. That's a vivid term. What does that actually look like?
Imagine an inverted pyramid or a house of cards. It's centralized, it's very efficient at pulling wealth to the top, but it's incredibly fragile.
So a black swan event hits.
And the whole thing just collapses. Trillions wiped out because there was no structural integrity.
Because there was no governance variable. It was all speed, no steering.
Exactly. And this is where the new physics comes in. The white papers propose a new equation. Instead of E equals mc squared, they propose E equals UD squared.
U and D. Okay, break that down for us.
U represents your resources. That's like your mass. But D represents Dean, or governance, the established order.
Wait. So they are squaring the governance. E squared.
Yes. And mathematically, that is the entire game changer. If your governance, your D is low. If you have corruption, no oversight, bad intentions, it doesn't matter how big your resources are.
The value just collapses.
It collapses towards zero.
Right.
Or like you said, explodes into entropy.
Yeah.
But if you have high governance, if you square that D, you can take a tiny amount of resources and generate massive sustainable value.
It creates an anti-fragile system, one that gets stronger under pressure.
Because the rules of the game are solid.
Okay, I think I follow the theory. Old system is fast and fragile. The new one is governed and anti-fragile. But governance is such a squishy word. How do you measure it?
I mean, usually it just means more paperwork, right?
Right, more compliance officers.
Well, that is the trillion-dollar question.
Yeah.
And to answer it, we have to look at a very specific failure in the banking world today. This brings us to the Usmani paradox.
This is the critique from Mufti Taqi Usmani about Islamic banking. Now, for listeners who aren't experts in this, why is this relevant to the whole global system?
Because it highlights a universal problem. And that problem is trust.
Okay.
Ideally, Islamic banking is supposed to be about musharaka, true partnership. You share the profit, but you also share the loss.
Kind of like venture capital. I give you money, we build something, we both have skin in the game.
That's the ideal, yes.
Yeah.
But Mufti Usmani points out this huge contradiction. In reality, these banks almost never do true partnership. They fall back on debt-like instruments, like Murabaha.
Which is basically, I buy this thing, I sell it to you for a higher price, and you pay me back over time. It sort of mimics a loan.
It's a workaround. Exactly.
Yeah.
And the reason why they do this is crucial. Usmani says they avoid partnership because of the risk of loss and the dishonesty of borrowers.
So the bank doesn't trust me.
They can't. How can a bank trust that you won't take their money and just cook the books,
Oh.
or hide the profits, or just be incompetent?
They can't.
So because they can't trust your agency, they fall back on the one thing they can trust: collateral.
Right. If I have a house, they'll lend to me. If I mess up, they take my house.
That's the old risk model. It relies on hardware, physical assets. But think about what that does to an economy. It means the only people who can get capital are the people
They
who...
already have capital.
Exactly. It limits the entire market to the rich. It creates that Pharaoh topology we talked about.
Okay, so here's where QGOS comes in.
This is where the new physics comes in. They ask the question, what if we could replace collateral with data? What if we could turn trust into a visible, trackable metric?
The agency sensors. And I'll be honest, this is where the white paper started to feel a bit like science fiction.
It does, but the science is grounded. The dashboard they describe, it doesn't look at your credit score. That's just your past. Instead, it looks at your binding delta.
Binding delta. Okay, this sounded like it was straight out of a neuroscience journal. Break this down. What are they measuring?
They're measuring the time gap between your intention and your action.
Yeah.
In cognitive science, binding is how your brain connects a cause like, I pressed a button to an effect. The light turned on.
So it's about how my brain perceives my own influence on the world.
Yes.
Yeah.
And the source material gets super specific. It says if a borrower has a binding delta of negative 45 milliseconds,
Negative 45. How is it negative?
that's the key. It indicates high stewardship,
Yeah.
high agency. It means your brain is registering the intent fractionally before the action occurs. It shows you feel a deep sense of ownership.
You see yourself as the cause.
Right. And if the number drifts the other way, into the positives, it indicates someone who feels like things are just happening to them. They don't feel responsible.
So, hold on. If I have this high agency score, this negative 45 meters delta, the bank knows mathematically that I'm not a fraud risk.
That is the claim. If you can quantify integrity, if you can measure agency, you don't need collateral. You can safely fund these high-growth partnerships with people who have zero property.
But high agency.
That changes everything. You're not just banking for the top 1% anymore. You're unlocking what the text calls sovereign creators.
People who are capable and honest, but just don't have capital.
And that is the survival argument for the banks. They're all fighting over a shrinking pie of people with collateral. This opens up a massive, untapped ocean of human potential.
Let's make this concrete. The sources use a specific example, financing a $500,000 apartment building. Let's walk through the old way versus this governance way.
Okay, so in the old way debt or standard Islamic banking, you sign a rigid contract. You have a fixed payment schedule. Don't miss a payment.
Right, adversarial. And if construction gets delayed or I get sick or the market tanks, the bank doesn't care. The physics of the contract is you pay or you lose the asset.
It's pure extraction. If you fail, they win. They get the building.
Okay, now the governance finance model.
The bank invests capital, M, as fuel, not debt. You're partners. But here's the kicker. The metric for success isn't just getting their money back.
It's the growth of my agency score.
Yes, because a more responsible you protects their investment. And they have a mechanism for when things go wrong. It's called the Mudga Protocol.
Budga. That's an Arabic term.
Yes, it refers to a stage in embryology, a sort of processing phase.
Hmm.
In the system, if you panic, say the market dips and your personal entropy rises,
The sensors pick that up.
they pick it up. Your binding delta might spike to, say, positive 60 milliseconds. You're losing that sense of agency.
And in the old system, that's when I get the foreclosure notice.
In the new system,
Yeah.
the funding pauses. It triggers a governance correction. The system basically says, hey, the reactor's overheating. The steward is panicking. It stops the capital flow to force a consultation.
So they stop giving me money to help me.
They apply friction to prevent a crash. It's a processing delay, a circuit breaker. It forces you to stop, think, consult, and regain your agency. Once you restabilize, the funding resumes.
So the asset isn't really the apartment building.
No, the real asset is you, the steward. The bank acts as a civilizational reactor. Its goal is to develop human capacity. The building is just the byproduct.
I can see why a borrower would want this, and I see the new market for the bank. But the sources talk about something bigger, national motivation. Why would a whole government care?
This is where we zoom out. Right now, nations are trapped in what they call a GDP race. We optimize for production. We just want that number to go up.
Even if it destroys the social fabric, you can have high GDP and high crime, high suicide rates, massive polarization. We see that everywhere.
Exactly. The sources describe a high GDP nation with low agency as a ticking time bomb, a pharaoh state. You have wealth, but you have high entropy. And here's the stark economic reality. Low agency people are expensive.
Expensive. How?
They require massive amounts of policing,
Right.
massive bureaucracy, huge welfare states. If people can't govern themselves, the state has to step in and do it for them. That costs trillions.
It's expensive to govern people who can't govern themselves. That makes perfect sense.
So the solution proposed is a new metric, not gross domestic product, but gross national sovereignty, or CDEV, cognitive development.
So instead of measuring how many widgets we made, we measure how developed our people are, their agency.
And a population of stewards, high agency people, requires less policing. They regulate themselves. They're immune to information poisoning and polarization. The text calls this a Medina state.
And the argument is purely economic.
It is cheaper to govern a high agency population. Stability is efficient. So nations will invest in this not to be moral, but because it's the only way to stabilize a modern society without going bankrupt.
Okay, so we have the why, survival, stability, new markets. But let's be realistic. The global financial system is a massive, stubborn dinosaur. They're not going to switch to binding delta sensors tomorrow.
You're absolutely right. And the sources are very clear about this. It's not a revolution where you burn down the banks. It's a hedge.
A hedge, like an insurance policy.
Exactly. Think about step one, the governance reactor pilot. A central bank isn't going to replace the dollar, but it might launch a sovereignty fund, a sandbox.
And the rule is?
Capital from this one fund is only released to projects that pass the governance clarity check, that D squared we talked about.
So it starts small, a parallel track.
Then comes step two, the entropy hedge. Think about institutional investors' pension funds. They are terrified of market crashes. They know the conventional market is high entropy. It bubbles and it bursts.
So they look at this new governance market.
And they see stability. The logic is, when the conventional market crashes, the governance market, based on real human agency, will remain stable. It becomes the new gold standard.
Which leads to the final step.
Step three, the agency standard. And this is the flip that just blew my mind. Right now, we use credit scores to decide who gets a loan. In the future, agency scores will become the standard for premium lending.
That's a fascinating inversion. Today, a high credit score makes you prime. A low one makes you subprime.
In the future, the sources argue that rational thinking finance, the old way, becomes the subprime market. It's high risk, it's prone to bubbles because it ignores governance.
And governance finance becomes prime. Low risk, high stability.
That's it. If you want cheap, stable capital, you have to prove agency. If you can't, you go to the old banks and pay high interest because you are a high entropy risk.
That is the checkmate. It uses the market's own greed for stability to enforce morality.
It really is. I mean, look at the comparison table in the analysis. Risk model. Old is collateral, which is past wealth. New is agency, which is future integrity.
Stability. Old is fragile boom bust. New is anti-fragile.
And the end game. Old is entropy, or heat death. New is essence, or legacy.
And the argument is that the big banks, the governments, They'll adopt this for the same reason they adopted the internet.
Efficiency and survival. You simply can't fight a system that generates more value, more E, with less friction. If you stick to the old model, you get outcompeted.
It's funny, we started this deep dive talking about physics and neuroscience, but we're ending up talking about what it means to be a good human.
That's the core insight of the new physics. Economics isn't about money, it's about human energy. If you treat people like cogs in a machine, you get chaos. If you treat them as stewards, you get growth.
So morality isn't just a nice to have, it's a variable in the physics of survival, D squared.
E equals UD squared. You cannot build a lasting civilization without squaring the governance.
This has been a mind-bending look at the future of finance. It leaves us with a pretty provocative thought for everyone listening.
It really does. The question is this. In a world drowning in data and debt, what are you building? Are you building assets that just generate rent?
Or are you building capacity that generates sovereignty? Because the physics of the future suggests only one of those is going to survive.
And looking at the charts, I know which one I'd bet on.
As always, thanks for diving deep with us. We'll catch you on the next one.